As the U.S. markets are closed for the weekend, we are looking at the final figures from Friday, November 7, 2025. Abbott Laboratories, ticker ABT, finished the session at $126.36. That was a positive end to the week, closing up $1.41 or 1.13% on fairly standard volume of about 5.46 million shares. The stock traded in a tight range, bottoming out at $124.65 and hitting a high of $126.62. And what's immediately striking about this price action isn't the modest gain itself, but the resilience it's showing. This stability is occurring despite a clear and documented slowdown in its diagnostics business, a segment that, for the past few years, was the company's poster child. This discrepancy, this gap between a slowing growth engine and a stable to rising stock price is where the real story is. And it's something many investors browsing on their Robinhood app might be overlooking. The common belief, the expectation, is that Abbott is a safe healthcare stock. It's a Dividend Aristocrat, a set-it-and-forget-it name you put in your individual brokerage account and don't worry about. People see the Similac on the grocery shelf. They know someone who uses a FreeStyle Libre, and they remember the flood of COVID tests. This creates an expectation of bulletproof stability. But the reality is far more complicated and, frankly, more interesting. The idea that Abbott is a simple, slow-moving defensive play is outdated. The reality is that this company is a high-performance machine firing on 3 cylinders, while one cylinder, diagnostics, is sputtering. The stock isn't being propped up by nostalgia. It's being driven by a ferocious and accelerating engine in its medical device division, which is completely masking the post-pandemic hangover in diagnostics. What many investors, even those using sophisticated investment platforms like interactive brokers, are failing to price in is this internal rotation. They are still looking at the blended average, not the powerful divergence between segments. The expectation is that the end of the pandemic testing boom would send the Apple stock of the diagnostics world into a tailspin. The reality, as shown by that $126 closing price, is that Abbott has already found its next act, and it's happening faster than many analysts predicted. This isn't just a healthcare company, it's a med-tech growth story wrapped in a diversified healthcare shell. Let's look at the recent movement and the numbers that support this. The stock has been in a tug-of-war for the last month. We saw a significant dip after its third-quarter earnings report on October 15th. On that day, the stock fell despite what looked like decent numbers. They reported an adjusted EPS of $1.30, right in line with expectations, and reaffirmed their full-year guidance. But revenue at $11.37 billion came in just shy of the $11.4 billion forecast. In a market obsessed with perfection, a tiny miss like that is an excuse to sell. The stock tumbled from over $129 down to the $125 level, and it's been fighting to reclaim that ground ever since. Friday's positive close suggests the bulls are starting to win that fight. But the headline numbers everyone focused on during that earnings call were the wrong ones. They saw the total diagnostic sales were down 7.8% organically. That's the expectation. COVID sales are gone. The segment is shrinking. Panic. But the reality? If you exclude those declining COVID test sales, the base diagnostics business actually grew 0.4%. It's not a barn burner, but it's not the catastrophe that the headline implies. This segment is also facing headwinds in China from volume-based procurement, a regulatory pressure that's hitting all medical device and pharma companies operating there. Now here is the part that investors using Fidelity investments to build their long-term portfolios should be focusing on. The real story of the quarter, the reason the stock didn't collapse, was the medical device segment. It posted 12.5% organic sales growth. This wasn't a fluke, it was the 11th consecutive quarter of double-digit growth. This is Tesla stock or Nvidia stock level growth, but it's happening inside a 130-year-old healthcare giant. And the crown jewel of that division is diabetes care, driven by the FreeStyle Libre platform. That product line alone grew 17.2% organically. This is the new engine of Abbott. It's a story of sensors, data, and chronic care management, which is exactly where the future of healthcare is. The company's heart failure, structural heart, and electrophysiology businesses all posted double-digit growth. This is the reality that is overpowering the expectation of a post-COVID slump. The company is successfully transitioning in real time from a diagnostics-led narrative to a medical device-led one. People who are doing their self-investing and just looking at the PE ratio, which is somewhere between 16 and 21 depending on your metric, well below the industry average of 29, might think it's cheap for a reason. They assume it's a value trap. But when you see this kind of growth in its most important forward-looking segment, the valuation looks less like a trap and more like a discount. This is a critical point for anyone looking for investment help or managing their own SoFi Invest account. It's easy to get caught up in the macro narrative. The healthcare sector as a whole, represented by the XLV, has been a mixed bag this year, grappling with inflation, higher labor costs, and uncertain government policy. But Abbott's performance shows why stock picking matters. It is not just a passenger in the sector, it is a leader with its own powerful internal catalysts. The online investment community on platforms like the Robinhood app often chases momentum. But the real opportunity here is in understanding this deep internal story. The company's other two segments are solid. Nutrition, the home of Similac and Ensure, saw 5.4% organic growth in its adult nutrition products. And established Pharmaceuticals, which sells branded generics in emerging markets, grew a healthy 7.1%. These aren't high-growth stories, but they are stable, cash-generating businesses that fund the dividends and the research and development in the high-growth medtech sector. This is the diversified business model working exactly as designed. So what does this company actually do for those who are new to the name? Abbott Laboratories is one of the world's most diversified healthcare companies, split into four main business segments. First, established Pharmaceuticals, which sells a portfolio of branded generic drugs outside the United States. Second, Nutrition, which provides science-based nutritional products for all stages of life, from Similac infant formula to Ensure for adult health. Third, Diagnostics, which provides the core laboratory systems, blood screening, and point-of-care tests. This was the division responsible for the Binax Now COVID-19 tests. And fourth, the star of the show, medical devices. This segment includes a vast array of life-changing technologies, from the FreeStyle Libre continuous glucose monitors for diabetes management to pacemakers, implantable cardioverter defibrillators, ICDs, and structural heart devices like the MitraClip. This diversification is its greatest strength. When one segment, like diagnostics, faces a predictable downturn, another segment, medical devices, has been cultivated to pick up the slack and become the new growth driver. This is the kind of quality and long-term planning that Fidelity mutual funds and other institutional managers look for. It's a strategy that has allowed Abbott to become a Dividend Aristocrat, having increased its dividend for over 50 consecutive years. When you invest online, you're not just buying a ticker, you're buying this business model. This brings us to the future outlook. The expectation is that Abbott will continue to be a stable, low-growth dividend payer. The reality is that its future is tied to the high-growth medtech market. The key catalyst to watch is the continued global adoption of the FreeStyle Libre platform. The company is constantly innovating, launching new sensors like the Libre 2 and 3, and even a new consumer-focused product called Lingo, which is designed for wellness and athletic performance. This is a massive expansion of their total addressable market, moving beyond just diabetes management. Furthermore, the pipeline in their structural heart and electrophysiology businesses is robust, with new product approvals expected over the next few years. These are not small, incremental changes. They are significant advancements in treating chronic, widespread diseases. The analyst community sees this. That's why 21 analysts have a buy rating on the stock, with an average price target up around $144, and some, like Barclays, seeing it go as high as $162. They are betting that this medtech growth engine will not only continue, but accelerate, forcing the market to re-rate the stock from a simple value name to a growth at a reasonable price, or GARP, investment. Of course, there are risks. The biggest risk is the one we've already seen, the macro environment. Economic uncertainty and persistent inflation could pressure hospital budgets, potentially slowing down the adoption of new medical devices. And the regulatory environment, especially in China, remains a significant headwind for the entire diagnostics and device industry. Competition is also fierce. In the diabetes space, Dexcom is a formidable competitor. And in other areas, Abbott fights head-to-head with giants like Medtronic and Boston Scientific. This is not a company operating in a vacuum.